Folks, it's Joe Valley with Quiet Light Brokerage, and today I've got one of our newest brokers with us. He has a ton of experience. It's David Newell. David, welcome to the team and Quiet Light's podcast.
Thank you, Joe. It's a pleasure to be here.
That's a funny accent. Is that Australian?
It's British, and I saw you write it as Australian in an email the other day. I was absolutely savaged by that. I was going to reprimand you.
I was only kidding. I was on the phone with Ben. We won't say his last name, but he's like, yeah, tell him he's a great guy, but I really don't like that Australian accent. He was kidding at the same time as well. Anyway, I'm going to kick this off just the way we do with every guest, David, and that is, can you give us some background on yourself? Tell us about who you are, where you've been, that kind of thing.
Yeah, well, I started life out in investment banking, actually. I did a business degree undergraduate and then launched myself into the wily world of investment banking. And I worked in mergers and acquisitions for Citigroup in London for 4 years, which, as you can imagine, is a very intense environment, but also an incredible learning environment. And there I got to work on some of the biggest tech, media, and telecoms, M&A and capital raises for the first 4 years. Of my life. And you learn a lot, you earn a lot, you don't sleep very much, and so at a certain level you start to think, I wonder what life looks like on the outside of this office. And so I left that, took some time to travel, and then shortly thereafter decided it would be really good to get involved in something smaller where I could have more of a managerial position and bring a lot of the experience that we had into a more exciting and a hotter area. And so that's when my online business brokerage life actually began. And, I started life out at one of your competitors at
our competitors. You're on the team now.
And so I started, like everyone does really, at sort of the bottom rung, with always the view to building up and becoming the role that I eventually took over, which was as the head of brokerage and operations there. And so over the 3-year tenure that I had, we obviously expanded very well out of London and moved overseas to Boston and built the team up. And so in that time, I must have done about 75 deals and sort of oversaw the rest of the team doing about 200. So a lot of deals across a lot of business models and a lot of niches. And it was a very exciting endeavor.
I was out for a walk this morning, and yes, folks, I'm in North Carolina, and it's sunny here. And I was thinking about having this conversation with you this morning, the fact that, you mentioned last time we chatted that you've done 75 deals, and I'm thinking, wow, David might have more experience than I do. And I'm adding mine up, and I think I've done more, but I've been doing it longer. That's the key.
Yeah, for sure.
But you have me by doing a larger deal than I've done as well, which is, it's great to have that experience that you bring to the team, just because that's everybody here at Quiet Light, a very successful entrepreneur, business person, and a great deal of skill and talent in the internet space as well. And you are also an entrepreneur as well. Can you touch on that just for a moment?
Yeah, that's right. I mean, I think one of the things that was just becoming kind of a burning seed for me in 2016, which is the year that I sort of decided to leave FE, was to strike out and become, sort of my own master and flex my entrepreneurial feathers a little bit. And so I spent, the best part of sort of 9 months, 10 months, just really resting and thinking into what I wanted to get involved in. And my personal interest is massively in self-discovery and personal development. So I got really deep into yoga and meditation and shamanism and breath work and all of these wonderful tributaries that are now becoming really big parts actually of modern culture. And so around this time last year, I actually launched my own online brand of self-discovery called Inner Truth. And it started as a podcast, and then we started to add on audio courses with various famous speakers from around the world. And the podcast has grown exponentially now and had some really amazing people. And I've got to interview some of my favorite authors, singers, writers, speakers, some actually like really famous people. So it's kind of a interesting life now, hopping on a podcast every week with a celebrity and
It's pretty
having
neat.
a chat.
Yeah.
Yeah. And amazing how fast it came about. So
Mark and I did a podcast on the benefit of podcasting for your business. And, for us at Quiet Light, it's just opened up doors to very successful authors, professors at Harvard, whatever it might be. And then there's these celebrities inside the world we live in, which is, e-commerce and SaaS and so on and so forth. But it really is a great tool for anybody that's running their own business. Start with a podcast. It doesn't cost that much. You can always edit out stuff if you're not good. I think actually when we did that podcast, I must have stuttered and stumbled in the first 3 minutes, and we decided not to edit any of it because we said, look, if we can do it, anybody can. And
100%. I remember the first episode I recorded was an hour long, and I spent 4 hours editing it.
Wow.
But I've got a lot smoother now, and there's a lot less going on. You sort of have to force necessity when you're doing some of the bigger guns now.
You certainly do. You certainly do. Speaking of big guns, let's talk about some of your experience in the e-commerce brokering world or internet business brokering world. A lot of folks think that Quiet Light is really specialized in physical products or e-commerce, as I'd label it, whereas the largest deal I've ever done was a content business. The next largest after that was a SaaS business. Sure, I do lots of Shopify stores with an Amazon component, or more these days, an Amazon business with a Shopify component. But you have a tremendous amount of experience in the SaaS space, right?
Yeah, exactly. I think, around 2014, 2015, we really started to spot this emerging trend of micro SaaS businesses coming up and sort of not really being thought about perhaps and valued in a very sophisticated way, given the strength of these businesses, the IP moat that they've got, and the recurring revenue. And so we really started to pour a lot of attention into what makes SaaS special. And we're very happy to start working with some great names like Patrick McKenzie and Rob Walling. And as they brought their businesses to us and we did successful exits for them, the floodgates open really. And so for me, I think, I sold several dozen SaaS businesses over my time there, culminating with, of course, the successful sale of Rob's business, Drip, to Lead Pages in 2016, which was an incredible transaction, both massively personally gratifying because Rob's such a good friend and great to get an exit, a life-changing exit for him, but also to sell into, a company as big as that with Clay as the CEO, super dynamic deal environment. And definitely a lot of learnings.
Yeah, Mark had Rob on the podcast talking about his story of building Drip and exiting from it. And it was a great podcast. If anybody hasn't listened to that, please do. But it's kind of funny. I remember when you were doing that deal and we were getting wind of it. And it's funny, we just thought, we don't want to do $10 million deals or whatever the number was. You have to fly all over the country. You got to put a tie on. I don't think you probably did any of that. And now we're doing deals that are that size and a little bit bigger. So we all grow up in this business and have to evolve, so to speak. So let's talk specifically about SaaS, though, David. For the audience that's out there, if they're running a SaaS business, if you're working with them through Quiet Light, you get a referral and boom, you've got a SaaS business that you're going to value. What are the top 3 or 4 things that you're going to sort of hone in on that is going to bring more value? Maybe even speak to the buyers here. What should they be looking at, and what would you look at as the seller's broker?
Well, I think that one of the most important, probably least looked at and least understood metrics of any SaaS business is churn. Churn really is the cornerstone of successful SaaS business because it is completely cancerous to revenue growth if you don't get that right.
Can you define that for folks that are just beginning to look at SaaS, what churn rate is and maybe how it's calculated?
Yeah, churn rate, I mean, you can look at it from a revenue perspective, or you can look at it from a customer account perspective. Revenue is probably more helpful. And that's simply telling you how much revenue or how many customers you're losing per month through cancellations, expiries, or sort of billings that aren't going through. And
And
It is.
that's measured against total revenue. And what's a good churn rate in the SaaS world?
Well, that's a great and a pretty seminal question that comes up a lot when you're evaluating SaaS businesses that specifically are targeting different end users. So if you think in like the B2B space, the monthly customer churn rate actually varies quite a lot depending on which business segment you're looking at. So if you have a SaaS business facing an enterprise segment, it's going to have a materially different monthly customer churn rate than one interacting or facing against an SMB segment, because those end customers have different purchasing behaviors. So in enterprise, for example, very, very, very low monthly churn is expected. You're talking like 0.5 to 1% a month, which annualized is 6 to 10%. But if you're looking at SMB, something between 3 to 7% is much.
What's
more
SMB stand for, David?
Small to medium-sized businesses.
Thank you.
And so annualized, that's more like 30 to 60%. And so now you can start to see that the difference between a 6% monthly churn rate and a 4% monthly churn rate is going to have a mega, mega, mega difference to the revenue profile of the business 12 months out from now.
Yeah. I want to talk about the other two aspects in terms of things that you look at in terms of the metrics, but the churn rate measured against the revenue, obviously the revenue has to continue to climb and new customers need to come in higher at a higher pace than the churn rate in order for the business to be growing, or even actually just staying steady, right? They can be losing 5% a month, but gaining 5% a month and revenues are flat. And the beautiful thing that buyers love about this is that, or SaaS businesses, that it's the recurring revenue. And they generally trade at a higher multiple. If you've got a straight up e-commerce business selling physical products with its own brand, even with a patent, I think that a SaaS business that's growing and has lots of growth opportunities and a reasonable low churn and workload is going to trade at a higher multiple. Is that your experience as well?
Yeah, well, I think that the recurring revenue piece is one explanatory factor for that premium in multiples. I think the other is simply the moat that exists around the average SaaS business. Having that intellectual property. We work in a space where if you can find product market fit very quickly with an Amazon business and very quickly start to scale it. But, with a SaaS business, you might have to pile in anywhere between 10,000 and 100,000 into development and may not even make a penny. And so one of the things that actually makes these micro SaaS businesses very valuable when they come to market is that actually they've simply found product market fit after having put down a lot of CapEx. And so it's interesting that that's actually a large amount of the value proposition for people that are looking to acquire these and scale them, because that in itself is finding, a diamond in the rough.
Right. So that risk is one of the four pillars for those that listen often. It's one of the four pillars, and it's, the lower the risk, the more, as David's talking about, the defensibility of the business, that moat around it, it lowers the risk, so therefore the value of the business goes up. All right, throw out another couple of metrics that you generally look at, and it's important for buyers to think about as well when they're looking at SaaS businesses.
Yeah, well, I think acquisition channel for the customers is really important. I think like the really premium SaaS businesses at the higher end of the multiple range are just like, every other type of business, managing to acquire customers across a multitude of channels. So the concentration risk is low, and that within those channels, the competition is relatively low. You can look at, say, the SaaS business in the project management space, which is absolutely saturated with VC-backed competitors. And that's a pretty frightening spot to be in. You'd much prefer to be somewhere in a quieter segment, just like we'd look at, in e-commerce. The same rules apply. I think it's quite nuanced in SaaS though, because, you have put down a lot of CapEx up front to develop the product. And so you have to be pretty savvy when it comes to acquiring customers at a reasonable rate.
Okay. So we've got the cost to acquire a new customer, the channel that you're getting them from, the churn rate. Anything else that really jumps out that you're looking at?
Yeah, I think the profile in terms of the revenue of the business is really important. So obviously we've been talking about MRR, but there's ARR as well, right?
So that's monthly recurring revenue and annual recurring revenue.
Yeah, exactly. And It's very tempting when you're a business owner, and this is quite an important thing that I think a lot of business owners can trip up on, to want to sell lifetime and annual plans at a grossly discounted rate in order to book that revenue. But when it comes to sell, it presents a pretty lumpy revenue profile and a major risk for the acquirer. And so actually the multiple that can be applied to MRR should be higher than ARR because it's more predictable. And this is even more the case when, you're using debt financing to buy a business. And so something that I would always do when I'm evaluating a SaaS business is actually use something of a blended multiple where I'd value MRR higher than ARR.
Right. So to further detail that and explain it a little bit, that annual recurring revenue, if you have 1 or 2 months a year where, let's say, the subscriptions are opened up and there's a flood of customers with a special promotion and a steeply discounted price for an annual subscription, but you're selling the business a few years later and you are 9 months away from, or actually just say 2 months after that annual subscription, the person that's buying the business, they're going to go 10 months without having that big bump in revenue. They're not doing any daily or weekly or monthly work for that revenue. It's going to occur. So there's no discount necessarily, but it can become a challenge. Like you say, when they're getting debt financing, they've got a monthly payment to make every single month. And if that big bump is not going to come for 10 months, it can be a bit of a challenge. That's great.
Yeah. And it's not entirely guaranteed that,
right.
that those annual subscribers will renew at the rate at which they came in at. And I think people expect a certain level of annual around Black Friday. But if the business is struggling to show MRR growth in off months, then that's a bit of a red flag potential.
Right. So from the buyer standpoint, you think really the focusing on the monthly recurring revenue, you got to look at the annual recurring revenue, but the more attractive business would be one that's got more monthly recurring revenue because it's spreading out that risk a little bit more.
100%.
100%. Yeah. Okay. Software that's out there to help SaaS owners measure these metrics. It's a challenge. Like I've looked at trying to calculate lifetime value. It's very, very difficult. Everybody does it a different way. Is there any particular software that you've seen more SaaS owners use than not?
Yeah, I mean, I really like the profit well analysis, actually. I think whatever you use, standardize. I think it's not helpful to swap between, Chart Mogul, Baremetrics, Profit Well, and just keep skipping around because then you're looking at very inconsistent numbers and methodologies. And if you're trying to evaluate, a number of SaaS businesses, there's just not a additional complexity that you want to put into your analysis. So I think stick with one, and the dashboard I've seen is the friendliest and the most well explained and the easiest to use is Profit Wells. And in particular, looking at their cohort analysis for churn is this incredible way of seeing whether the business underlying is improving or getting worse as new customers are coming on board.
Okay. Profit Well or Wells?
Well,
Profit Well. Yeah, I've seen Baremetrics used quite a bit on the SaaS businesses that I've sold. And it's a great tool for buyers and sellers just to go look at it and study what these metrics are that people are analyzing these businesses on.
Yeah, 100%. And there's a bunch of open source businesses on the Baremetrics platform where, you can just go and look right now at a number. I mean, you can look at Baremetrics own metrics, I believe, on their own platform, and like a handful of those. I think ConvertKit was on there for a while. It may still be. So it's fascinating to have a poke around. And once you've looked at, a handful of SaaS deals, you can really start to get a feel for what looks sensible and what doesn't around a lot of these metrics.
Gotcha. David, you've mentioned the term micro SaaS more than once. Can you define that for us? Is there a certain size? Is that what you're referring to?
Yeah, I mean, I think of micro SaaS as sub $1 million in value, but, really when I think about it more deeply, it's characterizing a business that has not gone down the sort of venture capital, deep investment, fast growth, pushing for a revenue multiple exit, and instead gone for the bootstrapped,
Gotcha.
slower growth way of doing it. And that is absolutely not to say that you can't take a micro SaaS and push it into the into that revenue growth multiple VC-backed territory is just that I think a lot of the businesses that we look at in our world tend to fall into the micro SaaS category.
Yeah, I sold one last year that literally was started by someone that had a problem and he solved it himself. It was a sort of a self-calendar tool. And he had it for like 14 years. But he was an engineer by trade, and you could tell by the interview that I did with him that he was not comfortable selling or talking. Very, very much an engineer. The person that bought it, very much the opposite of that, and is already talking to private equity folks to invest or get it to a certain point and take it beyond this sort of micro SaaS market that you're talking about.
Yeah, this is a really important point actually that I want to extend, because what I've observed in my experience is that a lot of the businesses that come up for exit were designed, by the engineer, by developer types that find a problem, that solve it, that, push it out to friends and family and other developers, acquire a customer base, it starts to grow organically. But they simply either don't have the appetite, the interest, or the skill set to market it, nor do they want to. And so these businesses become ripe for marketeers to take them over and actually work on building them out from a marketing standpoint, because a lot of them are in very good shape on the technical side. They just need more sales effort poured into them.
Yeah, the one I sold, it was doing, I forget exactly, let's call it $250,000 in discretionary earnings. His advertising budget on a monthly basis was $325.
Yeah.
So, yeah, I get emails, every week now from them. I'm on their list, the guy that bought it, and they're doing a much more aggressive email campaign, retention campaign, and adding new tools and features for the existing customers. Mm-hmm. Let's talk about the pitfalls of owning a SaaS business for those that are potentially buying one, for instance. What do you see as major pitfalls? And, I had a gentleman named Ezra Firestone. You probably know Ezra.
Yeah.
So I had Ezra on the podcast, and we talked about a number of things. He's very much into yoga and meditation too, by the way. But we talked about, he's got e-commerce businesses and he's got SaaS businesses, and he talked about the differences and what he likes about each and what he prefers. But I'd love to hear you talk about pitfalls, and I'll tell you Ezra's view.
Yeah, I think that the IP roadmap for any SaaS business is always something that you have to be very clear on. I think you can easily fall into a trap where you start to excessively design the product either around specific customers, and then it becomes this very odd sort of ball of mud. They like to use that phrase in SaaS world, where you're designing around specific customers, or you're just adding features to it that perhaps aren't really needed. And actually, I think that a lot of SaaS businesses actually benefit more from dialoguing with customers about how to use their products more effectively, because oftentimes they're only using about 20 to 30% of the functionality, and then often churning away because they're not aware of the other 70%. Than just like adding feature sets for the point of it. And of course, this really does stack up, because as you add more feature sets and add more complexity, you create more of a UX headache for your customer base. You create more of an operating manual to train your sales team with, and everything starts to slip out of control a bit. And I think that having a very crystal clear vision about the roadmap's actually like something that probably keeps a number of SaaS owners up at night contemplating that. I think churn is a real challenge for micro SaaS businesses specifically, because a lot of the time they're aimed at SMBs, so they're naturally facing against a client base that's got higher churn. And the best way really to reduce churn is to really improve your onboarding experience and your customer success. That's something Rob absolutely crushed at Drip, and one of the best-in-class onboarding processes I've ever seen. But it is expensive to do that unless you go down a very intelligent sort of IT-led onboarding route. And that's a challenge that I think a number of business owners struggle with, because once you get up into massive scale and you're VC backed, you can have a whole sales team that come on and really help train every single customer. But when you're in this micro space, you don't have the capital to do that. So you've got to think very creatively about really educating customers, really onboarding them very well so that you can solve the churn issue and scale the business well. And the churn's also important because it really starts to impact, your ability to run paid, for example, and acquire customers that way. And so there's a lot, you have to just be very, very thoughtful. So I would say churn is like quite a headache as a SaaS business owner.
Yeah, it sounds like any business with customers, take care of the customers first, make sure they're using the tools to the greatest extent possible, and that will reduce the churn, which will in turn give you more money to do paid advertising. You spend more than $325 a month. Yeah, I was going to go to the same place. Not that there's a right business or a wrong business to buy. They're just, physical products businesses are just different than content versus affiliate versus a SaaS business. So talking with Ezra about it, he owns both. He owns Zipify and he owns Boom by Cindy Joseph, or a portion of that one. In the physical products world, you create an ad and it hits and you scale. You spend more money on the ad. With a SaaS business, it may be the same, but then you've also got more support, more customer onboarding and focusing on that churn rate and the metrics. And, you've got the cost of those developers, which are an awful lot more expensive than the cost of, really good customer service people or graphic designers in the physical products world. Big difference though. And again, it all balances out. With a physical products business, you have to have working capital for inventory. If your business is growing like crazy, sometimes I've sold businesses that have been 24, 36 months old and had in-depth conversations with the owners of those businesses, David. They bootstrap it. They don't ever take any money out of the business. It's just growing, and all they do is take every ounce of profit, just trying to keep up with the inventory demand, that working capital demand. And sometimes they still run out of inventory. So there's two different ways to look at it, two different worlds. Those people that exit on the e-commerce world, they don't take a whole lot out the first couple of years. If they hung on, that accelerated growth always slows down a little bit, and they can then start taking a salary, pull some more money out of the business. But you don't have that physical product or working capital requirement for inventory and SaaS, but you got more expensive staff and developers that, if you've got a key developer and they go away, it's a key employee and you got to replace them. It can be very challenging, very expensive. So I'm not sure which is right. I always, I think people that are new in the internet space are coming from the corporate world and want to, live at home, work at home and see their family more, travel less. And I talk to a lot of people like that. They say, where should I go? What space should I look at? And I kind of think that they understand more easily physical products and can easily say, I sell a widget versus I sell a software tool that people subscribe to help them manage their calendar better. It's very different, very challenging, I think. What are your thoughts on that?
Yeah, I agree entirely. I think there's a lot of things to think about with SaaS. It comes down to, as in life, right? You always have to choose what problems you want to solve for. And some people like solving for very intellectual problems. It's very interesting looking at the buyer base for SaaS companies. They're often people that enjoy the intellectual challenge of having, a lot of the moving parts to think about. And there are people that enjoy the challenge of scaling e-commerce. So it's, totally personal preference. I don't think that one is better than the other. I think it's entirely like disposition of character.
Yeah. Well, listen, David, we've had you on talking about SaaS. You have more than SaaS experience, right? You've sold lots of content, lots of physical product sites in the past as well.
Yeah, more than I can remember. Yeah. I mean, when I really started my brokerage career, I spent almost exclusively doing content sites, all of the Amazon affiliate stuff, AdSense sites. And I loved them because, again, we talk about these beautiful nuances between different business models. For me, it was just so interesting looking up the SEO strategies of these businesses, looking at, the approaches that these owners have taken to rank specific pages. And I got super into like ad optimization for a bit and just fascinated with the psychology of ad revenues and clicks and so forth. So Yeah, I actually have a lot of reverence for AdSense sites, and I think I often look at them from my own personal acquisition perspective because I just love the passivity of those business models.
Yeah, yes, absolutely. For those that don't understand it, it's good quality content developed over time that's driving organic traffic, and you're getting paid for clicks, either through AdSense, or a lot of folks doing affiliate stuff as well when they're doing product reviews and things of that nature. But that was the larger one that I sold last year for just under 9 million, and it was a content site.
Wow.
Just crazy growth. A great story too, and we've had Ramon on the podcast. And this goes to the relationships with the people that we work with. The first one that we sold for business for Ramon a few years ago, let's call it 5 years ago, it was maybe $125,000 business. Then a few years later, he comes back as a client again. He says, "Okay, I've got another one I'd like to sell. It's $425,000." And then he comes back, in December of, I guess it was 17, and he's got one where we think it's valued around 5, and then we get it under letter of intent, and it's just exploding growth-wise. He's like, "Joe, I just don't think I can do this." It was a hard call for him to make on a Saturday afternoon in April of 2018, and he had to walk away from a $5 million deal because revenue was growing at 300% every month, which really just drove the multiple down and the total value up. We pulled the listing, and when the same person that was under LOI for $5 million, he didn't go away. He wanted to stick in, and he knew that the value was there. So he bid it up, and 2 others bid it up, and it sold for just under 9 million. Great story from that for that guy.
That's a high quality strategic exit there to come back at that level.
It was a risky move to walk away from 5 million, but it worked out for sure. And the buyer was fantastic too. You got to have a good buyer and good seller on both sides of the table. Yeah. Structurally, this is an aside, I know, but it was a combination of private equity money, a little bit of SBA money, some family fund money came into it, and then the buyer's personal money as well. And strange as it is, that particular buyer, David, also bought the largest SaaS business that I ever sold. So relationships with buyers are critical, as you know. Any quick tips or advice for people that are thinking about selling their SaaS business? What should they do? Should they just focus in on churn, or maybe have a conversation with you with an eye to exit even in 12 to 24 months? What are your thoughts there?
Yeah, well, I think definitely the advice varies based on how far you are out. If you're quite far out, I do think it's worth split testing price increases. We've seen over the years, I've seen a surprising number of wins from people making, micro price improvements. Obviously not, grandfathering existing customers, but trying that out. I think if you're closer into a potential exit, talking 6 months, like the really important stuff is actual, things that seem to have become like incredibly easy to miss. But, I've seen over the years, things like just securing IP properly. And then that's much more than just getting trademarks sorted out, but actually if you've had a lot of third-party developers working on the code, getting proper IP assignments, because a number of transactions I've been involved where they've had to be done retroactively is a little bit uncomfortable. I think another piece is around security. Again, if you're, not hashing passwords properly, or if you're, storing credit card data or any of these kind of things, like if there's any aspect of leakiness there, you really need to be on top of that. I think absolutely avoid, any kind of large discounting, annual plan discounting. Don't sell any lifetime plan type things. Any of that attempt to sort of artificially increase revenue and earnings 3 to 6 months out is really, really, really visible, unless of course it's around something obvious like Black Friday. And I think that, don't be too heavy with sort of trying to, cost cut. Because again, that's really obvious when you come into sale, that if in the last 6 months you've suddenly just gone extremely lean in order to get, an attempted inflated SDE, it becomes very obvious to any experienced buyer.
Very obvious. Yeah.
I think like one of the things that really does have like a pretty big impact in terms of leveraging the multiple up is, as much as possible, obviously document source code and annotate that well, but as you can, try and bring in, if you're the owner operator and you've done a lot of the IP yourself and built the code base, really start to consider 6 months out bringing on a developer and starting to hand that off. Because if you can show by the time you come to exit that a third-party developer that's been in the business for 6 months understands the code base intimately and has made, pushed out various updates, that is going to be a very compelling acquisition proposition for a buyer versus, that all of the knowledge is inside the owner's head. And then we've got to do a fairly elongated transition and hire a third-party developer as part of it. So do that work before and you'll get paid multiples upwards on the back end.
David, unknowingly, you've talked about the 4 pillars: the risk, the transferability, the growth, and the documentation. It's not just financial documentation, but it's SOPs and all the other stuff as well. All of the things that you're speaking to sellers about, buyers can focus in on the same thing when they're analyzing a purchase of a SaaS business. Everybody, David is reachable at david@quietlightbrokerage.com. Reach out to him there. He's up on the website now. Phone number extension is there as well. We'll put it in the show notes too. David, welcome to the team. I'm thrilled that you're a member of the Quiet Light team now. Thank you for being here.
Thank you, Joe. It's a pleasure.
All right. Touch soon.